Hey, thanks for taking another minute of your day to come check in on the topic today. We're taking a deeper look at something today for the real estate professionals out there. If you're thinking about getting into rental property, today we're taking a look at the financial cycle of a single, boom, added that late, rental property. And we just want to get a feeling of sort of the process of what you go from making the decision all the way to you get to your first sale and the real big decision you have to make here. We're going to outline that as we go through it. So obviously the first thing you're going to do, you need to make sure you're doing extensive research. You want to know what it means to get into investment rental property. You want to understand what these implications are going to be ahead of time. That's why we're doing a video like this. Somebody like that in that mindset can come check this out and look at these key points that they're going to be wanting to analyze at a deeper level. Now we'll come back and have a whole topic on that on its own one day, but let's move past that. We've done our good research. We know it's something we want to be in. We know the things we need to be considering. So we're going to move on to step 2, deal analysis. So now we're looking at specific deals. Hopefully you've got a financial professional of some kind that can take a look at this for you, help you understand the tax implications at this level, but we're looking at specific numbers now and we're comparing properties perhaps. We want to know what the implications are going to be financially, both from buying the property to having to operate it, to the capital costs associated with managing a particular property, and ultimately what are your margins going to be. Again, a lot of numbers associated here, all things that are harnessable if you get the right information, but that's the meat of that one. Generally speaking, this is taking the options you have, the property options you have, and comparing them in a very detailed fashion. And you need to do that before you get to step 3. Now, of course, once you've gotten through your deal analysis, you're gonna select a property, and ultimately, once you get into this game, you're gonna buy your first property, and boom, we're moving, we're making money. We get a little depreciation with our property. Again, these are things you've sussed out. Your acquisition cost, your depreciation, the management of the property operationally, who's gonna manage it, the financial costs associated with doing so. You've assessed all that already, and now we're lining those things up. How is it actually gonna work? If you haven't already done some of that prior to step 3, you're gonna be locking in on those things now. You're gonna have your financial documents laid out, how are things gonna work going forward, your income statements. You're gonna understand how depreciation is gonna affect your taxes. You don't need to know how to calculate it because you're working with a financial professional and you're a smart person. We're gonna get these things in line for you and make sure you're comfortably moving forward, knowing again those margins you have. You're not always gonna have the same margins as the person next to you. You're gonna be working with theoretically a certain amount of cash flow, and you're gonna have capital expenses that arise. So you just need to have a plan for how to deal with it, because again, if you're making this picture work in these steps 2 and 3, you're gonna be in a spot when you get to step 4 here at the operational level where things can work smoothly. A lot of it is a numbers game. You can't predict when a lot of the unpredictable stuff is gonna come up, per se, right? When a big capital expense hits, you gotta put in a new furnace, a new roof. But again, we shouldn't be buying properties without having done all these steps to make sure that we're not gonna get hit with some wacky thing that's gonna torpedo the whole venture, right? So again, research. We're doing it. We got the right information from the right professionals. We're doing our own research. We get here and we're operating the property. Everything's smooth and we're working well. You're a great manager, operator, whatever you're doing involved in, but you're keeping that ship running smoothly because again, you've done your research, you know what you need to be doing. And eventually, what's gonna happen? You got into it for investment, right? So at some point, we're gonna get to the idea of a sale. And what are the 2 big things when it comes to investment rental property? Again, I'm a CPA, I'm a tax guy. This is what's gonna be very, very important to me, is managing this aspect of it. And when you get here, you need a plan for whether you're gonna sell this and be done with it, or whether you're gonna continue investing in rental property. So what is ultimately the decision? Are we going to 1031 or no 1031? What is a 1031? Specifically a 1031 exchange. That is going to mean that when you get to the point of selling your investment property, you are going to exchange it for a similar property per se. So let's say just happen to say that the property you happen to be swapping it for is the exact same amount. Ultimately, you're going to retain the same amount of tax basis in the property, and any additional amount you'll have to say, if you have $300,000 in your old house, you're buying a $400,000 house, you might have to cover some of those additional expenses. But the important part is you don't get hit with the capital gain if you do the 1031 exchange. You get to defer that. Again, key item is defer. It's not gone. It gets deferred down the line until ultimately you sell a property and don't do a 1031 exchange. So again, here's our key decisions. 1031, no 1031. If you go with the no 1031, meaning I'm gonna sell the property, I'm gonna accept the capital gain, and I'm gonna be done with that, done with investment property at this point, you wanna have a plan for that early on, because what that's gonna lead to is you're gonna wanna plan for those taxes ahead of time. And if you're effectively, unless again, you're gonna play a tax inefficient game of doing this and investing down the line without a 1031, you're effectively exiting the game of investment rental property. Great decision if that's what makes you comfortable. There's nothing wrong with that. Now, again, we're going back to the idea of planning. What it all underlies is this decision here, a lot of it. So if we are expecting to continue, we want to have just the most detailed, well thought out plan for what we're going to do here. What kind of property are we looking at next? How long are we staying in this game? Because really, if I'm being honest with you, this should be a game you play until you die at the most efficient level, because what you can do is you can push this down the line, let's come all the way up here, push it all the way up here. If you're able to plan appropriately where you can play this game, you push and push and push, and you're 1031 and you're putting this property in a trust, what you can do is ultimately avoid a huge amount of taxes, and that's the game the wealthy are playing. They have these properties that they're buying new properties with, financing new properties with, not truly selling and getting out of the game. They're 1031, they get to the end of the life cycle because those properties are in a trust. Once they pass away, those properties pass on to the heirs at a very tax advantage rate. Oftentimes what is known as what happens is what's called a step up in basis, meaning they get an increased level of value for the property that when they sell it, they're gonna get hit with a much smaller level of long-term capital gain because of the way this was thought out, planned, and ultimately structured. So again, very big long-term play here. A lot of details that go within each of these categories, but these items in red over here are what drive everything you need to be thinking about here, because all of it leads to this idea of like, am I playing the long-term 1031 game, or is this more of something where I'm gonna manage a property, I enjoy doing it, but it's more of a short-term deal. I'm gonna make sure I get to the long-term game period, of course, but at that point, I'm not 1031 and I'm gonna exit the game. You wanna have those plans built into every one of these steps along the way, and as long as you're working with the right people and thinking about the right things along the way, those things are gonna happen inherently. So just make sure, again, you have these right details in mind, you're having the right conversations along the way that can truly build you a plan that underlies what you're gonna do long term. It takes a lot of pressure off you, it's gonna take a lot of pressure off the people you live with and the people you care about, and ultimately you can turn this into a very big wealth grower for you, if that's what you wanna do. Come back next time, we'll have another subject. Thanks for joining.